Welcome to Woods of Stardon. This is CH. I will be covering the ABF Singapore Bond Index Fund that has the SGX Stock Code A35 in this video, which is part of my Absolutely Biased Comments or ABCs series. The aim of this series is to cover one fund per video to share how an individual investor can try to find out more about a fund from public sources and do some basic research or simple due diligence on the fund before deciding to buy the fund or walk away. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. This video is done as a follow-up request from a viewer's comment in my previous video covering the Global X Defense Tech ETF. If you would like me to cover any funds or ETFs, do drop me a comment in any of my videos, and I'll be happy to work on it as long as I can find enough information on the product. The ABF Singapore Bond Index Fund is originally a product owned by DBS Asset Management that was acquired by Amova Asset Management in 2011. Interestingly, both DBS Asset Management and Amova did not add their own branding identities to the fund name, making it difficult to figure out at a glance who actually runs this fund. ABF actually refers to the underlying index, which we will go through in a while. The ABF Singapore Bond Index Fund should also not be confused with the ABF Pan Asia Bond Index Fund, which is a different product listed in Hong Kong and managed by State Street Investment Management. Amova Asset Management is the rebranded name from what was previously known as Nikko Asset Management. The company was formed in 1999 from the merger of Nikko Securities Investment Trust and Management and Nikko International Capital Management, while the rebrand was actually done recently in September 2025. I personally like Nikko Asset Management as a better identity for its origins, so I don't really understand why the rebranding needs to be done, but that's just me. Amova is a directly owned subsidiary of Sumitomo Mitsui Trust Group, a big conglomerate in Japan. While having a strong Japanese heritage, Amova brands itself as a global asset management firm and operates in 10 countries and regions globally, managing over $270 billion of AUM. Amova's product solutions outside of Japan onshore mainly revolve around Asia in both equity and fixed income aspects. There are efforts to produce more global solutions, but this is not easy, especially that the number of competing fund providers and fund solutions have grown significantly over the years. The ABF Singapore Bond Index Fund would fall under the Asia Local Currency Bonds product category. Despite the fund name, the ABF Singapore Bond Index Fund is actually an exchange-traded fund or ETF. It is set up as a Singapore open-ended unit trust listed and traded on the Singapore Exchange with the trading name ABF SG Bond ETF and the stock code A35. As a standalone unit trust, there is no fund family or multiple sub-funds, so it has its own dedicated prospectus. While the ABF Singapore Bond Index Fund is an ETF, and most ETF providers don't bother providing fund manager information, it is good to find Amova providing detailed bios of the fund managers for this product in the ETF prospectus. I am not sure if this is a MAS requirement for Singapore-listed ETFs, but more information is always better than less for investors. The lead fund manager is Joanne Chia, who has 15 years of industry experience and is the deputy head of Asia and Singapore Fixed Income. She is responsible for both active and passive Singapore fixed income portfolios, as well as absolute return Asian fixed income portfolios in Amova. Joanne is assisted by Lance Zhang, who focuses on quantitative research and development, as well as assisting in optimizing, rebalancing, and management of the ETFs in Amova. The ABF Singapore Bond Index Fund is an ETF that tracks the iboxx ABF Singapore Index, which is where the fund derived its name from. Let's find out more about this index. S&P Global, or more specifically the S&P Dow Jones Indices division, is the index provider for this index. S&P is best known for its iconic S&P 500 index and S&P credit ratings, but it's actually a huge US financial services firm providing financial information, analytics, and energy and commodities intelligence. S&P Global has 73% majority ownership of the S&P Dow Jones Indices, which is a joint venture with CME Group. S&P Global merged with IHS Markit in 2022, and as part of the merger, it added the iboxx indices into its offerings. The iboxx indices provide a comprehensive coverage of bonds and loans markets globally. One of the index families under iboxx is called the iboxx Asia Bond Fund Index, or in short, iboxx ABF. iboxx ABF covers specifically local currency sovereign and sub-sovereign bonds from China, Hong Kong, Indonesia, South Korea, Malaysia, Philippines, Singapore, and Thailand. The broadest coverage is called iboxx ABF Pan Asia Index. The iboxx ABF Singapore Index, that is the benchmark for this ETF, is therefore a Singapore-specific subset of the iboxx ABF Pan Asia Index, covering Sing dollar sovereign and sub-sovereign bonds with at least 1 year maturity. While the index definitions technically allow for inclusion of Sing dollar bonds issued by other countries covered within the iboxx ABF Pan Asia Index universe, we are talking about sovereign and sub-sovereign bonds here. So in reality, this ETF essentially is a pure Singapore country exposure. We will look at the index construct through the ETF portfolio details later. As mentioned earlier, the ABF Singapore Bond Index Fund is an ETF that tracks the iboxx ABF Singapore Index, which essentially covers the Singapore sovereign bond market. There is not much details on the investment strategy in the ETF webpage and fact sheet, so let's go through the prospectus instead. The prospectus is actually pretty detailed. It first states the ETF will primarily use a full replication strategy, that is to invest in the same bonds and with the same weights as per the index. The ETF, however, has the flexibility to use a representative sampling strategy as needed. And the main reason would be in event of insufficient market liquidity for the ETF to invest in the appropriate bonds and with the same weights as the index, since the Singapore sovereign bond market is not really big. The ETF in this case can invest up to 20% into Sing dollar bonds outside of the index that have a minimum size requirement and have similar aggregate characteristics as the index components. This follows with a lengthy section talking about passive management methodology. That is essentially how the ETF ensures that the tracking of the index is optimal. The ETF can actually hold up to 10% in cash equivalents to facilitate trading liquidity, although this obviously creates a tracking error against the index that the ETF needs to minimize. As per the prospectus, the ETF expects annual tracking error to be less than 0.4%. It is also mentioned that there is a dedicated and independent risk performance management team, as well as internal credit assessment standards and process to handle the relevant risks involved in managing the bond portfolio. Last but not least, it is clearly stated the ETF has a Sing dollar based currency and is traded in Sing dollars only. The ABF Singapore Bond Index Fund was incepted and listed in August 2005, giving it over 20 years of track record. AUM is over 1.1 billion Sing dollars, which is very decent and is one of the larger Singapore bond-focused ETFs. Country allocation is purely Singapore, with minimal cash set aside for trading liquidity purposes. As mentioned earlier, while the index and the ETF have the flexibility to invest outside of Singapore, There is hardly any reason to do so, unless the ETF size grows so big that the Singapore bond market is not enough to fill up its portfolio. Sector allocation shows about 83% of sovereigns that are the usual Singapore government bonds. There is about 16% in government agencies and some residual allocations in financial services and utilities. These are, however, not corporate bonds. The ETF webpage provides issuer allocation as well, that shows the non-sovereign exposures are the few government agencies and government-affiliated businesses that issue bonds, including HDB, LTA, Temasek, and SP Power Assets. Given the portfolio has over 80% in sovereigns, it is inevitable to see the top 10 holdings displaying only Singapore government bonds. As this is a small market and there aren't that many government bonds available, it can be seen that the issue weights can get as high as 6.5%, even though the portfolio has over 70 holdings as per indicated in Morningstar. The ETF has a low tracking error of 0.1% on 3-year annualized basis. The resulting portfolio is very high grade at AAA credit rating because Singapore is one of the few countries in the world that enjoys a AAA sovereign rating. Portfolio statistics are similar to the index, with weighted average yield to maturity at 2.38% and weighted average duration at 8.33 years. The relatively low yield and high duration is expected for sovereign bond exposures, as countries commonly issue very long-dated bonds as part of their longer-term monetary planning, with yields similar to the prevailing interest rates. Investors considering this ETF will have to ensure they are okay with these aspects. Morningstar gives us a bit more details on the portfolio. We can see the maturity exposures are quite evenly spread across the different time periods, although this is dependent on how the Singapore government wants to manage its bond issues in accordance to its policies. We also see a small portion of unrated bonds in the credit rating chart, as it is common to have government-affiliated bonds unrated given the small issue sizes and limited investor demands, similar to some Singapore corporate bonds that are unrated as well. The ABF Singapore Bond Index Fund comes in only one share class that is listed on the Singapore Exchange with the stock code A35 and is traded in Sing dollars only. The ETF has a management fee of 0.15%, which is decently low. Adding other expenses gives a total expense ratio or TER of 0.24%. The ETF website nicely provides details on the different ways for investors to trade the ETF. The first is obviously trading on the Singapore Exchange or SGX. And given this looks to be a solution catered for Singapore investors, the ETF can actually be traded in cash, CPF via the CPFIS ordinary account, as well as Supplementary Retirement Scheme or SRS. The second way is Regular Savings Plan or RSP, where you keep adding a predetermined investment amount over time with a predetermined investment frequency. Besides the list of participating dealers provided in the ETF website, many banks and online platforms provide RSP or similar mechanisms for investors these days. RSP is not for everyone though. It is more suitable for investors who have a long investment horizon and also conviction in the product to want to continue increasing allocation to it over time. The third way is direct subscription or redemption through participating dealers that is more common for institutional investors. This approach bypasses the hassle to bid for a price and subject to trading liquidity on the stock exchange, but there is a minimum trading volume required. In this case, the minimum stated for the ETF is 50,000 units, which calculates to less than 60,000 Sing dollars based on the current NAV. This is much lower than many other established ETFs in the market, which means retail investors can actually use this approach as well, if the minimum trade volume qualifies. There is no trading data available in the ETF webpage, so we can't review that. From the Morningstar data, we can see there is a bit of premium discount gap happening historically, with the biggest gap of 0.56% discount in 2017, comparing price versus NAV, though the gap seems smaller in recent years. This is annual returns data, however, so the daily trading situation may be very different. The ABF Singapore Bond Index Fund has a semi-annual distribution frequency for its one and only share class. The ETF provides distribution data in an Excel file that can be downloaded from the ETF webpage. The file is unfortunately not really useful, as it contains only the distribution dates and amounts of the last two distribution payouts, so investors don't get to understand longer-term yield expectations. We therefore rely on Morningstar again, that has distribution history for the past 5 years. Not perfect, but at least much better than the one-year data from the ETF documents. On average, the ETF has been paying out about 2.32% per annum distribution for the past 5 years. This is similar to the weighted average yield to maturity of the ETF. So it is essentially paying out the yields received in the underlying portfolio. Given the ETF and index are basically a portfolio mix of Singapore government bonds of different maturities, this also implies that the 2.3% to 2.4% can be considered the long-term interest rate expectation for Singapore economy. As such, investors should expect the ETF to generate a distribution yield of around this level for the long term, regardless of short-term interest rate fluctuations. While 2.32% doesn't sound a lot, it does add up over time to a substantial amount. As seen in this NAV versus total return chart since the ETF incepted in 2005, distributions take up majority of the returns. In fact, if we look at just past 10 years, the NAV hardly grew, so all the returns are from the distributions. The ABF Singapore Bond Index Fund provides performance data across various time periods in its webpage and factsheet. The webpage also indicates the 3-year annualized tracking error is a low 0.1%, which is well below the expected 0.4% mentioned in the prospectus. The ETF performance is correlated to interest rate expectations and movements. We can see the 1-year and 3-year annualized returns are high at 4 to 5% due to declining interest rates, while 5-year annualized return is low at less than 2% because the bond markets corrected during the sharp interest rate hike period in 2022. In the long run, the ETF delivered an annualized return of 2.34%, that is similar to the current distribution yield as mentioned earlier. Here is a 10-year performance chart from Morningstar comparing against the Singapore Overnight Rate Average or SORA, where we can see the negative correlations clearly. What this also implies is that this ETF should not be treated as a low-risk or safe or capital preservation solution, even though it is a portfolio of AAA rated Singapore sovereign bonds. One of the most significant corrections happened from November 2020 to September 2022. As the world went through COVID normalization to post-COVID reopening to sharp interest rate hike regime, the ETF corrected and suffered a minus 16% drawdown. If you had invested directly into a specific Singapore government bond issue, a minus 16% drawdown is a temporary pain because you know that as long as you hold the bond towards maturity, the NAV will move back to par, so there is certainty on the capital at the end of the day. For a fund or ETF, however, there is no maturity per se, and therefore it is difficult to predict how the NAV or capital will be at the time of your redemption. On the flip side, a fund or ETF gives you the potential of participating in NAV growth, so your investments may end up more profitable than holding a single bond issue. At the end of the day, all investments are effectively exchanging some form of potential risk with some form of expected returns. The volatility of the ETF and index returns can also be observed in the calendar year returns from Morningstar that we briefly looked at earlier. Taking into consideration the ETF has a long-term average return of 2.34%, we can see there are some multi-year exceptionally good periods as well as exceptionally bad periods. So investors do have to be prepared for such swings in the returns. This is not the only ETF available that tracks the Singapore sovereign bond markets. There is also the X-Trackers Singapore Government Bond UCITS ETF that has a slightly lower TER of 0.2% and has a near identical performance. So interested investors are free to choose from the two. For investors focusing on long-term capital preservation, it may make more sense to go for Sing dollar money market funds instead that mainly invest in very short-term Singapore government notes and fixed deposits. Using Fullerton Sing Dollar Cash Fund as example, we can see it has not lost out too much returns in the past 10 years while ensuring you have a good sleep at night. On the other hand, investors with higher return expectations will need to look for solutions that include corporate bonds. The Lion Global Short Duration Bond Fund and East Spring Singapore Select Bond Fund are used as examples to compare here, where both have portfolios mixing sovereigns and corporate bonds while maintaining Sing dollar focused exposures. Lion Global, with its short duration approach, has less interest rate impacts and therefore actually exhibited a higher return with lower volatility. East Spring, on the other hand, is normal duration and simply offers a notably higher return in the long run. With that, let's summarize our findings. Amova Asset Management, previously known as Nikko Asset Management, is an established Japanese asset manager that is relatively small compared to popular global fund providers, but is decently recognized in Singapore and Asia. The ABF Singapore Bond Index Fund is one of two ETFs listed in the Singapore Exchange that tracks the Singapore government bond market and traded in Sing dollars. So this is really meant for Singapore or Sing dollar investors who want to get specific exposure into a portfolio of Singapore sovereign bonds only. The ETF tracks the iboxx ABF Singapore Index, that is a subset of the iboxx ABF Pan-Asia Index family. This is a popular index family used to represent Asia's sovereign bond markets. The ETF webpage clearly states the different ways to trade the ETF, from cash and CPF investing to RSP to directly trading with dealers. While the ETF has a decently low 0.24% TER, it is slightly higher than the 0.2% TER of its competitor product from X-Trackers. The ETF provides distribution data only for the past 1 year, which is not ideal. It would be useful for investors if the ETF provides the data for a longer history. While Singapore enjoys the highest AAA credit rating, and this is a product with a portfolio of Singapore government bonds that have negligible likelihood of defaulting, it is important for investors to understand that sovereign bond funds and ETFs are not necessarily a low-risk product. Interest rate risk is one of the biggest concerns, and the ETF has had a notable minus 16% drawdown in recent years. Investors should look to diversify risk by looking for other appropriate investment solutions to complement this one. In conclusion, this is a well-known ETF in the industry that tracks the Singapore sovereign bond market and intended for Sing dollar investors. Interested investors need to be clear about its features and risks to invest prudently. This concludes my absolutely biased comments on the ABF Singapore Bond Index Fund that has the SGX Stock Code A35, and I hope it will help in your investment journey. May we all grow wiser and prosper.